What's going on? Welcome to my channel. I am the covered call guy, and on this YouTube journey, my goal here is to create $120,000 in annual passive income. I'm currently holding 6 cover call ETFs, and if you want to know what they are, I reveal it at the end of every month. So know what I'm holding, what I'm buying, what I'm selling, and if I don't buy anything, what my cash reserve is and what I'm expecting to buy. My projected annual dividend slash distribution income is about $70,000 a year. 5.8K a month, 1.3K a week, $191 per day, $7.99 per hour. All right, legal disclaimer before we start. This content is for informational and educational purpose only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube and I could be completely wrong. Okay, all right, so let's just get that out the way. Today's video is really going to be a warning slash opinion piece because I am seeing it trend again on social media. And when stuff trend on social media, it could get very dangerous, especially if you're on my channel and you are new. My channel is growing, and I don't know if a lot of you guys are new or you're trying to get into the income space, or you're not new to investing, but you are new to the income the higher yield, and you're transitioning from the growth, you're retiree, right? So we're gonna be talking about STRC, right? I'm gonna be, from my point of view, at least I think I'm gonna be trying to expose the $2.5 billion trap. This video we're gonna ask is STRC the ultimate yield illusion? Okay, the reason I'm making this video again is I'm starting to see it trend on X again, and I just want to make another refresher video because perhaps things have changed, right? And I've seen Michael Saylor's X post promoting it too. So I have to see what's changed, okay? This is my forensic breakdown of it again for March. Okay, this is my March breakdown. I did another video on this like a month and a half, 2 months ago. So let's see what's changed, right? So why is it trending again? Okay, so I'm going to say why you're being targeted right now, right? So why are we all desperately looking for high yield right now? So we're going to have to talk about the harsh macroeconomics reality facing not just retirees, but anyone tempted by this juicy 11.5% yield, right? The STRC is offering today, right? And another reason is inflation is pushing us to look for high returns outside of traditional safe havens. Okay, that's one of the biggest reasons why, right? Not everybody has millions of dollars to be able to just park it at a 1, 2, 3, 3.5%, 4%. All right, so this is, at least my opinion, the perfect bait for desperate yield seekers. Okay, let's talk about your nightmare. We are in an economy where inflation and erosion of purchasing power is crushing us, including myself, right? Even if I earned this much, it is still crushing me. If you are in a Gen X or retiring, you know that traditional safe haven assets like government treasuries and corporate bonds just don't pay enough to cover the escalating costs of living and aging, right? Especially with what's happening with the geopolitical environment. However, if you're looking at STRC, I think this is their trap, right? So Strategy Inc., formerly MicroStrategy, led by Michael Saylor and Fong Li, pivoted their entire software company to be the world's largest corporate holder of Bitcoin. To fund this, they launched a $2.5 billion initial public offering in July 2025, okay? This is STRC, a variable rate perpetual preferred stock. Understand though, okay? So STRC, I think, at least targets a vast pool of capital desperate for inflation-beating yields without equity volatility. Okay, so let's look at it. Is the 11.5% a guaranteed lie? Okay, so at least I view it this way. They market STRC explicitly to traditional fixed income investors just like you. If you're looking at it for this, they're pitching it and it sounds perfect. So let's look at it. 11.5% dividend yield, tax deferred status, low volatility, and fully liquid. 4.6x over collateralized, backed by massive Bitcoin treasury. Now, you do have to look at this and say, wow, this is really perfect, right? But is it really a safe, steady Eddie investment? And you gotta ask yourself, is it good enough? What's really behind this, right? You look at the You gotta look underneath the engine, right? So I did my own rigorous forensic analysis of their prospectus. You always got to read that. And structural fragilities will shock you, okay? Did you read the fine print? Because if you didn't, then you're going to know how extreme, their PR, great marketing. They're going to give you the guise of safety, but it's not really safe. Okay, let's ripping the SEC fine print. All right, so we're gonna be looking at the official SEC prospectus and read the rules they don't advertise. What did you actually just buy? Okay, so let's look at the secret panic button. Variable dividends. Okay, STRC has stated par value of $100. So the defining features here is that the variable monthly dividend rate completely controlled by the board of directors. Why do they vary it? Well, it's to artificially keep the trading price near $100, okay? So when crypto crashes, you inherently demand a high return to hold STRC. So the board must hike your payout to stop the price from catering. Okay, so let's look at the data. So by March 2026, Bitcoin dropped roughly 24%, give or take. Making of this video is about 24%, right? So to stop a panic, right, the board was forced to hike your dividends 7 consecutive times, bringing it up from 9% to 11.5%. Okay, so dividend hikes are a mechanical response to deteriorating underlying risk profiles, especially with STRC. So what is the 8% death spiral trap? Well, I'm going to break it down into 2 sections. The first part is the downward trap, okay? The board can hike the dividends easily to appease you, right? But they can't cut it easily, right? The rules dictate they cannot reduce it by more than the secured overnight financing rate. We're going to say SOFR for short, right? Plus 25 basis point. So if the company faces an acute cash crunch, they are mathematically constrained from cutting distribution quickly to save the company. So what is the 18% penalty spiral? Well, if they fail to pay you, unpaid dividends accumulate. So the penalty rate steps up to 10% plus 100 basis point, scaling annually up to a massive 18% per year. Okay, this is a dividend stopper. Legally prevents them from paying junior shareholders until you are paid, right? So this sounds like protection for you, but it's actually accelerate their debt spiral into insolvency. So it looks good on paper, okay? Contractual rules meant to protect your payout actually speeds up their corporate liability compounding during stress, market stress. Okay, this is not a normal preferred equity. Okay, so look, I put this together, the structural comparison. Look at it. Look at how far STRC deviates from standard corporate preferred equity issued by productive businesses. Okay, so looking at this, traditional preferred stocks may pay dividends from real business profits. Very important distinction here, okay? STRC completely severs this link, funding your yield by continually selling more stock while setting up a massive 18% penalty fee. This can get very, very dangerous. Okay? Heads, they win. Tails, you lose your life savings. Okay? So the prospectus has redemption clauses that disadvantage you, right? Strategy Inc. retains an optional right to call your shares at $101 at any given time. They also have a cleanup redemption right. What does that mean for you? That means if a company's credit improve miraculously or if interest rate plummet, making your 11.5% yield incredibly value and juicy on the open market, they will simply buy back your shares from you at $101. This is the unfair trade that a lot of people don't talk about. You absorb the eliminate downside risk of crypto crashing, but your profit is contractually capped at a nominal 1% premium. Okay, these are what we call embedded call options that structurally cap your upside while you are holding all the downside risk. Okay, the masterclass in financial gaslighting. So how do they use words associated with safety and stability to obscure a highly speculative asset instrument? Okay, it's all psychology here, right? This is the digital credit buzzword scam. I hate this, right? So this is, they give you your 15-second pitch, the X post, so keep it short, the memes, right? So Michael Saylor explicitly calls STRC short duration high yield credit. He claims it turns Bitcoin into fiat cash for investors who demand $10,000 a month forever. Okay, this is their boast about pitching this to military retirees and conservative 70-year-olds in 15 seconds, promising you will live happily ever after with this steady Eddie investment. Okay, we gotta look at the legal reality. This is not a bond. This is not a credit. Traditional bonds represent a senior legal claim on a productive business. STRC is a perpetual preferred stock sitting deep within a highly leveraged capital stack. Okay, so in a bankruptcy, you have absolutely no creditor rights until all senior debt is entirely satisfied. That means you are at the near bottom of the pile for getting paid. Okay, you understand this part. A lot of people don't talk about this. They just look at the yield and what's behind it. Oh yeah, we can fund it. You know, we have the cash reserve. That means nothing. Hey, let's look at the tax-free illusion that eats your money. The first claim is the marketing claim. Okay, Strategy Inc. heavily promotes that 100% of the distribution paid in 2025 were treated as a non-taxable return on capital for IRS purposes. That's great. I don't want to be tax deferred. They even promise, though, we'll run our business to be able to give everybody tax-deferred earnings for the next 10 years. It does sound like a genius tax optimization for your portfolio. But here's the IRS truth. So under section 316 of the IRS code, not financial advice, I'm not a tax advisor, you go ahead and hire a qualified tax accountant. But under this code, as of now, what I've known, disclaimer, I don't know anything about taxes. A payout is only taxable dividend if paid from earnings and profits. If a company has zero E&P, they legally must classify payout as ROC. Okay? Strategy Inc. has zero accumulated E&P. Why? Because they operate at a massive net loss. Okay? I believe reporting a 12.4 billion loss in quarter 4 25 alone. Okay, they have no profits. Right, the tax deferred exists because the firm lacks taxable profits, not because of operational tax optimization. Understand the difference. Right, so watching them feed your own life savings back to you. Okay, this is a structural rock funded by capital rising because there are no earnings. So let's do the math on what this means for your actual money. Okay, you have $0 in actual cost basis. Essentially, you are eating your own money. Mechanically, a return of capital distribution reduces your cost basis in the stock. So if you purchase STRC at $100 and receive $11.50 in ROC distribution over a year, your cost basis drops to $88.50. Basic simple maths here, right? We do $11.50 minus 100, right? We can all get that. We all understand that. So when investors consume these distributions thinking they are living off a yield, you are actually cannibalizing your underlying principal until it hits zero, at which point it becomes a taxable gain. So understand this different. I'm not saying it's bad or good. It just depends on how you want to play it out, okay? Structural ROC from unprofitable companies simply hands you your own investment back in monthly installment. Which high yield issuer can you think of? You can think of a few. Come on, list it in the comments. I know you guys can think of it. And if you don't know, ask in the comments. My subscribers will let you know. Okay, the multi-billion-dollar over-collateralization risk myth, right? So they claim you are protected by massive Bitcoin treasury, but who actually gets to claim that Bitcoin if things go wrong? Okay, exposing the fake BTC rating. Okay, as much as I love Bitcoin, okay, they're not doing a good thing here by kind of, perpetuating that, it's safe, it's steady. Okay, the fabricated metric here is that management pitches a proprietary metric called BTC rating, claiming STRC is a 4.4x to 5.15x over collateralized by Bitcoin. This is what they boast. Okay, it's more than in any investment grade bond. Actually, 5 times over collateralized, more than just about anything else we would be competing with. Okay, and that's what they're telling you. That's what they're boasting. Fact check it, because I don't think it's true. The absolute priority rule here is that this metric intentionally ignores absolute priority rule. We're going to use APR for short. in bankruptcy terms. Right? So APR mandates a strict hierarchy. Senior debt must be paid in full before preferred equity, which is you. Okay? They get paid before you even get a single cent. So even their own fine print admits that BTC rating does not account for cross defaults or serve as a liquidation analysis. Okay, understand, they can say a whole bunch of things, but at the end of the day, they are bound by legal statutes. Okay, so you are dead last in bankruptcy court. So I just made a chart here and where you stand. All right, so let's look at the actual claim priority. So if Bitcoin suffers a severe, sustained decline, this is who gets paid from the remaining collateral before you do. The first is absolute seniority. Second is subordinates, right? And then 3 is deeply subordinate, which is your stock, STRC. And then 4 is residue, right? MSTR. That's basically the last. You're basically last at the bottom, right? If you're not first, you're last. All right, the broken engine burning billions. If a company generates no operating cash flow from software or Bitcoin, where does the cash actually come from to pay your 11.5% yield? For those who are new, for those who are new to the channel, I always ask this of my high yield ETF and stock. Where is this yield coming from? How do they make their money? How do they make their profits, right? So this is one of the questions we have to ask. If Bitcoin doesn't produce anything, where is that 11.5% yield coming from? All right, the never-ending dilution machine. First, no organic yield. So Bitcoin is a non-yielding bearer asset, right? It generates absolutely no organic yield and produces no fiat cash flow to pay your dividends. 2, the ATM machine. So in 2025, Strategy Inc. became the largest equity issue in the U.S., raising an unprecedented $25.3 billion by selling new common stock into the open market. The reflexive loop is that they issue STRC to buy Bitcoin, then lacking cash flow, they issue new common stock, MSTR. The cash raised from new MSTR equity buyers is routed to pay your STRC dividends. What does this look like to you guys? What does it look like? Okay, the 2.25 billion safety net sandcastle. And why do I say that? Because let's talk about their management, right? Management heavily promotes a 2.25 billion USD reserve. It claims that it can provide 2.5 years of coverage for dividends and debt entrance, right? Funded entirely by selling more stock. Of course, that's where they get the money from. So let's do the math. 2.25 billion divided by 2.5 years equals an annual baseline cash burn of 900 million per year. So STRC alone requires 400 million of that. Senior debt consumes the rest. Right? This is the critical flaw. Why is nobody talking about this? Right? So this just assumes a static dividend rate. If the board is forced to hike the dividend significantly to maintain the $100 peg during a crypto crash, this highly touted 2.5-year timeline collapses rapidly. It might even drop to 1 year, 6 months. Right? This cash reserve is finite. All right, depleting asset not replenished by organic operating cash flow. Okay, let's look at the most extreme mismatch in modern history. Okay, prudent treasury management matches the duration, volatility, and cash flow profiles of assets to liabilities. Okay, Strategy Inc. has engineered the exact opposite. Okay, this is the ticking volatility time bomb. So let's look at early 2026 when the company deployed 54.26 billion into holding. It's about a little over 700,000 Bitcoin to service a high yield fiat liability using a zero yielding digital asset. You either sell the asset or continually dilute equity. And of course, they're going to refuse to sell Bitcoin, right? They own stable US dollar. They owe stable US dollars to you. But then, it's collateralized with hyper volatile Bitcoin. So when Bitcoin dropped roughly 24% to 65.9, their treasury went underwater by $10,000 per coin. Yet your fiat dividend requirement remained rigid. So actually, they had to increase the cost to 11.5% yield to appease the market. This is extreme negative convexity. convexity. Okay, when the value of the company's asset decline, its required cost of capital increases simultaneously. That's not something you want. That doesn't make sense. It's not going to work out. Bitcoin has to pump or they're done for. Okay, economic proof. Okay, people are saying this is a Ponzi finance. Don't sue me. Okay, this is just academics I'm using from Hyman Minsky. Corporate financing structures can be categorized into 3 distinct stages based on their income debt relation. The first one is hedge finance, right? So cash flow from operations are sufficient to cover both principal repayment and interest or dividend obligations, right? This is the safe, traditional way. Number 2 is speculative finance, right? So cash flows are sufficient to cover interest obligations, but not the principal, okay? Requiring the firm to constantly roll over debt. And then this is the Ponzi finance. So cash flow cannot cover either principal or interest, right? The entity is forced to continuously borrow more or sell assets to meet payment commitment, okay? So under Minsky's academic classification, the STRC structure exhibits the precise characteristics of Ponzi finance. Okay, I'm not going to say Ponzi scheme, just Ponzi finance. Don't sue me. Okay, the reflective death spiral. Okay, so as long as investors are willing to buy MSTR stock at a massive premium, they can harvest cash to pay your dividends. But what happens if the market turns? Okay, let's look at the positive loop though, right? In a bull market, rising Bitcoin prices drive MSTR premiums up. This allows accretive ATM stock issuance, which funds more Bitcoin purchases and fills the USD reserve, easily sustaining your STR dividend peg. Okay, this is the only way I see them pretty much surviving, is if Bitcoin continues to go up. The organic circuit breaker, well, there is none. Okay, a sustained crypto drawdown plummets the MSTR stock, right? The ATM machine freezes because it becomes hyper dilutive. Okay, deprived of ATM capital, they burn the reserve. The peg here breaks. Okay, the ability to pay your dividend structurally evaporates if the influx of new capital cease. What does that sound like to you? Okay, so why are they doing this? I'm just gonna say follow the money. At least this is where I got it. This is what I'm trying to follow. So why would a company, engineer this? Look at how they get paid. Executive compensation is decouped from GAAP profitability or operating cash flow. So CEO Feng Li receives a total yearly compensation heavily weighted towards performance bonuses tied directly to parity targets like BTC accumulation and BTC gain. Okay, so they are financially rewarded for aggressively issuing STRC, raising fiat, and buying Bitcoin. If it succeeds, they reap massive equity compensation, and if it fails, you bear the downside risk. And with Michael Saylor holding the ultimate voting vote, there is no independent board to stop them. It's whatever he wants, and it might not be in your favor. Okay. All right, the final reckoning. Will it survive? Okay, so let's look at it. Institutional research requiring looking at both sides fairly. Okay, this is not a hit piece. This is not a trash piece. I'm not talking about STRC. Don't ever buy it. I'm just saying look at it from a totality point of view, and not just looking at the surface yield and what people are posting and trending on social media. Okay, so let's look at the bear case, right? Total capital annihilation. What can trigger this? Well, under a sustained contraction in cryptocurrency markets, the reflective loop inverts rapidly. Okay, we've seen kind of that happen a little bit, but not really prolonged right now. So declining asset value reduces collateral coverage. All right, this is the speculative premium of MSTR common equity contracts, right? So it means the ability to conduct at the market equity issuance disappears entirely. This is the trigger. This is the collapse, right? So relying exclusively on the finite USD reserve, management is forced to yield hikes to sustain the par peg. Of course, no one's gonna want it if it's not the yield. You're not yielding, the more than you're losing here, right? Accelerating the reserve depletion. So when the reserve exhausts, they're going to have to suspend your dividend and the $100 anchor disappears, okay? STRC reprices as deeply subordinate equity. And then the absolute priority rule leaves you with severe capital impairment, because remember, you get paid last. Okay, let's look at the bull case, right? In the bull case, we can ask, is this the endless money glitch? As long as there's a bull, market, right? Digital capital. So proponents argue Bitcoin function as a form of digital capital if it appreciates long term. The balance sheet naturally strengthens, it's expanding collateral coverage and reducing perceived credit risk over time. So, is it an endless money glitch? Well, the perpetual financing mechanism is that if common equity consistently trades at a premium to NAV, the company can raise capital pretty much forever. Okay, STRC acts as the income tranche of this ecosystem. Okay, it's basically a whole loop, giving you money, you take it back, giving money, you take it back, giving money, you take it back. Okay, the bottom line is that at the end of the day, you might be the exit liquidity. Okay, I want to say my opinion that STRC is not a safe fixed income asset. Okay, it is highly leveraged, short volatility bet on human greed. Your safety depends on 100% of other people continue to buy wildly overvalued MSTR stock so the company can pay your dividends. If that music stops, you are left holding the bag, okay? Simply put, your safety depends entirely on whether other people keep buying MSTR stock to fund your dividends. This is the only way I see it. I don't see. I just. This is what my deep dive led to me. For those who are holding STRC, let me know what conclusion you came to. I think there are a few of you that hold this stock, so it's as much as I love Bitcoin. I think I would stay away from this one. I think there are better, sustainable, reliable, more consistent, quote unquote safer high yield, right? If you want 11%, there is GPIQ, not financial advice, right? 11%, there is SPY-I, right? And a little bit more, QQI. Why not just go for BTCI? I'm just saying, okay? This is my conclusion. Okay, what do you think? Subscribe, comment, like. Thanks for watching. I always appreciate your analysis in the comments. I do have a lot of smart people in the comment section, so I'm very grateful for that. So let me know if you think STRC is a brilliant financial innovation or a fragile house of cards that is just really starting to collapse. So let me know your thoughts in the comment section below. Always appreciate you guys watching my videos. Stay tuned. Catch you guys on the next. Thanks for watching.